Welcome to Oregon Cash Flow Pro. My name is James Barber. I'm an expert on designing high cash value life insurance policies that maximize your cash growth, not the agent commission. This has always been our approach to cash value life insurance, and it will continue to be that way. And we're going to share with you as much information as we get so that you can understand these products and make sure that you are getting the best designs for your situation. In yesterday's video, which you can check out here, we explored the new Allianz Accumulator IUL, and today we're going to continue looking at the differences in that product. This is an excellent cash growth product. The prior product ran for 13 years. That was the Pro Plus, the Life Pro Plus. Probably the best product in the industry. It all depends on your funding situation, but for really high funding levels, it's an amazing product for what you can get for it. I've discussed that in a number of videos. But this new product comes with a few changes, and they're basically all good changes. We don't tend to see that very often. Usually when we see product changes in the IUL space, it's usually a reduction of benefits. The products haven't been known to get better over the years, but I think a lot of that is because for most of the existence of the IUL, we were in a lowering interest rate environment. And so insurance companies' general funds have been performing slightly worse year after year after year. Now that we're back into a higher interest rate environment, we're seeing general funds do better. We're seeing better cap rates, better participation rates, better fixed interest rates. But we haven't yet seen better products start to come out until now. Be sure to check out that video from yesterday so you can see basically all of the changes we identified in the illustration that we went through showing that. So we're just going to touch on some of the things that we've learned since then. One of the things we found out today was in the old product, the premium loads were 8% for the first 9 years and then 4% after that. But if you funded it higher than the MEC limit, there was a 14% load fee during the first 9 years. The biggest impact on that was when people were doing 1035 exchanges and they're trying to move large dollar amounts in. If they're also contributing cash, it would bump them above the MEC limits. It doesn't create a MEC when you're doing a 1035 exchange, but the numbers would be higher than the MEC limits and it would trigger that 14% charge. They've done away with that. So with the new load fees, they're doing a one-time charge at 9% for the first year, and then 5% after that. So each year after that. It's a pretty nice change. And you saw in the illustrations we did yesterday that we're essentially having net gain from the client side in reduced expenses on overall load fees. Certainly during the first 20 years. And it takes a lot of years before it would probably be more efficient to have the old product design. And in this case, now we can do 1035 exchanges and we don't have to worry about that 14% load fee. They've adjusted some target premiums for older age folks. Now, we didn't hear if they went up or down. My assumption is that it went down because target premiums for older people just tend to be high anyways. We have a minimum of $100,000 death benefit on this particular product. And so if you're 65 years old, that target premium is pretty hefty and there's no way for us to reduce it even at that $100,000 death benefit. So we're going to take a look at that in the future here and see how those adjusted, and hopefully they came down. In general, an IUL is not necessarily good for older people anyways, but the higher target premiums at those older ages just made it worse. You have to be able to fund it at a pretty high level for it to make sense if you're in your 60s and you're looking to get an IUL. Like, in general, that's a good rule to think of. It doesn't mean you can't do it effectively, but you definitely want to be funding it at a higher level so we can take advantage of the blended designs that we're doing so that the money you're getting in is significantly higher than those underlying expenses. And it's just harder to do for older people if we're not funding it at a really high level. In that case, we would look at different products. There's some other products that work better at lower levels. And realistically, it may not even be an IUL, but there are some IULs that can work because we can do less than 100,000 for the base phase amount. We've got that higher classic bonus. We talked about that. The premium deposit fund, we don't really encounter use of that too much because we're going to give up control. If you're sitting on cash that you know you want to contribute as life insurance premiums, you can put it into the premium deposit fund account. It can only be done at issue, and it can make the payments for up to 10 years. Well, they're going to give 6% for that. That rate can adjust year to year, but that's where it's at now with this new product. Like I said, in general, most of my clients don't utilize that feature because we give up control. You can put that into a high yield savings account or a CD or something and maintain better control of it. You don't necessarily need to get the 6%. For some people, it works. They don't want to have to think about it. They want to just shift those funds. Okay, we do get that increase. We've got the new index options. So interesting things we found out about the new index options. I'm going to go over those more in depth here in just a few minutes. But we have a blended futures ER and the S&P 500 futures ER. These are not volatility indexes. The S&P 500 one is all equities. And I think the blended one is almost all equities as well. The Bloomberg used to be, well, it was a volatility index and it had a bond component to it. And they're doing away with the bond component. So the older product will still keep the balance 2, the Bloomberg balance 2. But the new product went to the balance 3. And I missed that in yesterday's video because I hadn't paid a whole lot of attention to Bloomberg, because once we got into the rising interest rate environment, that Bloomberg Dynamic 2 has been really underperforming the PIMCO. And so our focus has been on the PIMCO. PIMCO has a mechanism in it that does better in a rising interest rate environment. And so we've continued to see good returns with the PIMCO over the last few years, whereas we haven't with the Bloomberg. Now, it doesn't mean that the Bloomberg 2 is going to do bad in the future. It's still going to be available. I still expect good things from it. I just don't know when that's going to come about. And then we have a lower lock. We have a lower lock feature available in the lockable indexes, and we put out a video about that as well. Check out the link for that right here. In fact, I locked one of mine in that video. You can check it out. But we did set our targets. One of those targets hit this morning, the day after I set the target. And then they have the risk class upgrade program extended through Q3. We did talk about that in yesterday's video. Okay, let's look at the S&P 500 futures. This gives us a graph showing the difference between the futures ER, which is the new index being offered, and the S&P 500 index, and we can see that the performance is right in lockstep with it. This comes with an 80% participation rate, no cap. So there are some really good years that if you were in the S&P 500 with the 12.5% cap, which is still available, there's no bonus available with that one, and we're going to end up with 0 years when the market's down. And then we cap out when the market's up at 12.5%. We can see here that with the classic bonus option, we have a 1% floor because we always get that 1% bonus. And then we get 80% participation of whatever the actual S&P return was, plus the 1% bonus. So these are the numbers that we end up getting. So instead of getting capped at 12.5% here, we would get 22.64. Instead of getting capped here, we would be at 26%. Instead of being capped here, we're at 23%. So there's some really good opportunities for some great growth. And there's no 0 years because that 1% is the floor. So I'm really excited about this one. One thing to keep in mind, any of these indexes, though, that are not volatility indexes, we're probably going to see greater variance in the participation rates from year to year because they're going to be subject to the volatility. The prices of the options that we get on these things are going to be subject to the volatility greater than our volatility indexes. Now, one of the big reasons for the change in the new product is they wanted to institute some new index options. We've got the 500 futures index. You can see not volatility controlled. They're going to track the 3-month S&P 500 futures, and there's no bond component. It's equity only. So we get to see the makeup of the index: 80% large cap, 10% small cap, 10% tech, and they're just going to address volatility by moving to cash. So rather than moving to bonds, that's apparently how they're going to be addressing the volatility in the new Bloomberg 3. And then we have the blended futures index. This one is also not a volatility control. It's using the futures, and it's also using a predetermined blend for all years. We can see 40% into the Bloomberg 10-year note, 30% in the S&P 500 futures, 20% Bloomberg small cap custom futures ER, and 10% to the Bloomberg International Equity Custom Futures ER index. These are all lockable as well. So we've expanded from just having the PIMCO and the Bloomberg as a lockable index to now we're going to have PIMCO, Bloomberg, the S&P 500 futures, and the blended futures as lockable options. So it'll be interesting to see how this one performs in relation to these other ones. The blended that was used in the prior product never really attracted me because the cap was always really low. It was like an 8.5% cap. I don't like to be capped that low. If you get zeros in any years and you're capped at 8.5% on the good years, it has to cap out in order for it to really make a good average over the course of a few years. So not thrilled when we see caps of 8.5%. I really do like uncapped index options. So some good options on that new product. And then we looked a little bit at when you might choose some of these index options. The S&P 500 futures gives us equity exposure. It's uncapped. It's lockable. We just have to accept that the participation rate might fluctuate quite a bit in year to year. The blended futures ER is a 60-40 equity bond static mix with some exposure to large, small, and international equity. Also uncapped and lockable. Again, this is not a volatility index, so that participation rate may fluctuate quite a bit. We've got the PIMCO. This one is a volatility controlled. It is uncapped and lockable. Participation rates will be higher than pure equity allocations, and this one will be more stable. And historically, it's been really good. Still a big fan of that one. Bloomberg Dynamic 3. This is volatility controlled. Diversified equity exposure. We got large cap, small cap, and tech. It's uncapped and lockable, but no bond exposure. So less exposure now to interest rate movements. That should come with higher participation rates as well than something that's pure equity. So that's the value of the volatility control indexes, is the options are less expensive because the indexes are less volatile. Now at Allianz, they do have ongoing discussions about whether they're going to offer any of these new index options with the older products. It hasn't been decided one way or the other yet. So if you have an opinion on that, if you would like to see these, might behoove you to reach out to Allianz and let them know, hey, I heard you got these new index options. I'm hoping that those can apply to my product that I already own. Give them a little nudge that direction. Certainly on the agent side, we're going to be talking about that and urging them to be able to do that. And the reason there's a discussion about this is we don't want clients to be confused about which index options to choose, because obviously the Bloomberg 3 is very similar to the Bloomberg 2. Our clients are not necessarily going to understand the small differences between them. They're going to need to talk to an agent. And the reality is there's a lot of clients out there that their agents are no longer around. That's just the way the industry works. Agents don't tend to stick around for very long if they're not making any money, and you end up with clients that don't have an agent that they can go talk to about these things. Now, Allianz has a really robust website that gives a lot of detailed information about the index options, but that's not in a lot of people's wheelhouse to go and dig in and figure out which way they might want to go. There's a really neat feature that Allianz offers that you can go in and you can plug in your projection for the market for the year, and it'll suggest which index options you might choose for that year. But again, most people don't pay attention to the market. They might not know how to answer those questions, where they might not even understand how to make a guess at what the market might do in the future. And if they don't have an agent they can talk to, then it just becomes more confusing for them. So that's part of where the discussion is at, is they don't want to make it more confusing for the clients. They want to keep it simple if they can, but they also want to provide as much as possible and certainly meet any demand that's out there. So like I said, if you have a product like this and you're interested in getting these added to it, it wouldn't hurt to reach out to Allianz and probably ask them to add these index options to your old product. Now, I did talk about this in the lockable feature video that we did right before this one, but they did already extend that lower target lock. It's like setting a stop loss to older products, to the prior product that's no longer available. That's pretty neat. And from a business standpoint, that's what we tend to see from Allianz. They're really, really good about taking care of the client and not just trying to pad their pocket with more money. When the interest rate environment went up, the fixed account went up, the index participation rates went up, and the cap rates went up. And it basically happened with Allianz before we saw it happen with any of the other carriers. So it was really neat to see that, because I just like how they do business. It not only is it a great product and design, but I think Allianz has shown a dedication to doing well in treating customers who already own the product. Whereas you kind of get the feeling that some carriers don't care as much about people who owned the prior products because they're already locked in and they might have to pay surrender charges to get out or whatever. It kind of always reminded me of cell phone companies where they'll offer discounts and free phones to new clients. But if you're an old client, sorry, tough luck. I can't tell you how many cell phone companies I've changed because they wouldn't, even though I'm spending hundreds of dollars a month on cell phones, they wouldn't offer me what they would offer somebody that just comes in off the street and is a new customer. And so they lose my hundreds of dollars a month in business because they didn't want to offer me the same incentive. And essentially, I have to go be a new customer somewhere else in order to get some type of benefit. I always hated that model. Allianz doesn't engage in that stuff. And I really appreciate that. So, hope this was helpful for you. If you have any questions about this, leave them in the comment section below. You can always reach out to me, schedule a meeting at calendly.com/cashflowpro. There's also a link to that in the description below. If you want to schedule a one-on-one, it's a great way for me to answer any specific questions you might have. And obviously I can do illustrations and I can design policies for you if you're in the market for it. If you have an illustration, I also do analysis of those. So you can always come to me with an illustration you got from somebody else, and we can look and see, is that the best design? So I look forward to meeting with you guys in the future. In the meantime, hit that like button if you appreciate the content we're providing. Subscribe if you haven't subscribed, and we'll see you next time.
I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here, and we'll see you next time.
Now go maximize your cash flow.